All right, Katrina, thanks. Well, Congress raised the limit on the national credit card to $9 trillion yesterday. The U.S. is a debtor nation, but does that matter? Will the negative savings rate hurt consumers in this rising interest rate environment? Joining us with more is Steve Leisman, CNBC senior economics reporter. A couple of guests, Steve.
You got one of those credit cards, Joe, that has a $9 trillion limit on it?
I have. I use a debit card.
Let's see what that looks like. Well, look, here's the deal. Consumers are the key to the economic outlook this year. With such a load of debt and a negative savings rate, do they cut spending and repair the balance sheets this year, or do their balance sheets even need repairing? Joining us from Santa Rosa, California, Charles Biederman. He's the CEO of Trim Tabs Investment Research. And from Stamford, Connecticut, Peter Schiff, president of Euro-Pacific Capital. Let me begin with Peter this morning. Peter, yesterday we had some data that showed home delinquency or home mortgage delinquencies were on the rise. I think that's the leading edge of problems for the consumer?
Well, the consumer is going to have a lot of problems. And I think, when you look at the savings situation, I mean, from a global perspective, what America is really doing is we're squandering the world's scarce savings on consumption. And the whole concept of savings involves underconsumption and self-sacrifice. The concept is that an individual earns money but doesn't spend it all, and the resources that he saves are freed up to be loaned to an entrepreneur who uses those resources for capital investment, which ultimately leads to greater production and rising consumption in the future and a higher standard of living. But it doesn't do any good for a Japanese citizen to save money and then give it to an American who wastes it on consumer goods. They could have done that themselves. Back in the 19th century, when America borrowed from the rest of the world, we borrowed to produce. We borrowed to build factories, to build infrastructure, which enabled us to export products back to the world, to pay the interest on our debts, and to repay the principal. But now all we can do to repay these debts is print money.
Charles Biederman, let me ask you this question. Is the consumer in rough shape and about to turn around and repair his balance sheet?
Well, I disagree totally with what the prior guest was saying. Cash on household balance sheets has been rising at a mere 6% rate over the last 4 years. Take-home pay grew by over 9% last year. Yes, there is a balance of payments deficit, but what the balance of payments deficit doesn't count was that U.S. holdings of foreign equities rose by $1 trillion last year, a lot more than a $700 billion increase in the balance of payments deficit. And that doesn't include the increase in the value of foreign wholly owned subsidiaries of U.S. companies.
Peter,
so
what about that, Peter? We own more of their stuff than they own of ours. At least that's the way it's growing.
That's not the case. The foreigners own more assets in America than we own abroad. That's why we're the world's greatest debtor nation.
Not true.
We're not the world's greatest debtor nation?
Well, we also have a lot of equity. You're just looking at balance of payments and cash flows. How about the equity side of the equation?
No, foreigners
U.S. has a lot more. No, it's not so. It's not so. Look at the numbers in the. I'm sorry.
No, foreigners own more assets in the United States than Americans own abroad. And the bottom line is we are going into debt. I mean, if things were so great, we wouldn't be raising the debt ceiling.
Peter, I had a feeling we might have a little bit of disagreement here on what the data actually say. Peter, let's talk about the savings rate, which has been negative for 3 quarters in a row. And I want to get back to my original question. Is this a time, you think, when consumers will begin to repair that their balance sheets and increase their savings rate?
Well, unfortunately, I still think consumers are going deeper and deeper into debt. But they're going to have to eventually, and I think it's not going to be because the consumer comes to his senses. It's going to be because the lenders come to theirs. I think it's going to be from abroad where the discipline is finally put back onto the American consumer, because certainly we have to stop spending, and all the consumption that we've been doing for the past decade or so is coming at great cost to future consumption. See, our economy isn't growing. All we're doing is consuming and borrowing money.
Charles
Biederman, the only problem with that is that consumer credit has been growing at a whopping 3% annual rate since '02. Take-home pay grew by over 9% last year, well over 9% this year. Higher interest rates mean more interest income. That is over $6 trillion.
Yeah, it means more interest income.
Instruments.
It means more interest.
More interest income for U.S. households.
No, it's more interest income for the Japanese and the Chinese. Americans are paying interest. We're not receiving it.
Foreign equity markets grew by over 20% last year. U.S. holdings of foreign equities, the value soared last year. The U.S. market was up minimally last year. Foreign holdings did not grow the value is anywhere near.
Oh, certainly.
You got to look at both sides of the balance sheet, David.
Peter,
you got to look at equity and debt.
I don't disagree that we're doing a lot better with our foreign investments than foreigners are doing with their U.S. investments, which is one of the reasons that they're going to stop investing here. They're wasting money. There's far better opportunities abroad than there are in the United States. But we are going into debt. Those are the realities.
I got this panel together so that I could better understand the issue. At least I better understand that there's more questions out there. Charles Biederman, what's been happening to net home equity? And what we did here is we put a chart together that looked at the equity that people have in their homes, and it shows that it's declining slightly from about 62% to about 60%. Are people too much in debt relative to their homes, Charles?
Home values are growing much faster than mortgage debt. Less than $1 trillion of mortgages are going to be resetting this year, and you compare that to the increase of several hundred basis points in short-term credit instruments held by households. Households are much better off in a slowly rising interest rate environment, then they're hurt. Take-home pay is surging. The consumer balance sheet is doing well. Yes, if the U.S. government stops spending as much money more money than it's taking in, that would help. I totally agree with that.
Peter, real quick, last word.
Yeah, quick point on housing. First of all, home equity does not represent savings. If anything, it represents a potential drain on savings, because the only way to access home equity is to either borrow against it or sell your house. But either way, it drains savings. Home equity, real estate is a bubble. These prices are fantasies. To say that people's balance sheets are improving because their liabilities don't look too bad relative to their home equity, that home equity is an illusion. It's going to evaporate over the next few years.
Okay, Peter, we got to leave it there. Thanks very much. Peter Schiff, president of Euro Pacific Capital, joining us from Stanford, and Charles Biederman, president and CEO of Trim Tabs Investment Research.